Well, hey everybody, this is Dan Vanderkoy here with Mana Insurance Group. Thanks for jumping on and watching this video today. We've had so much interest with this new House bill on the long-term care coming out that we figured instead of just doing webinar after webinar after webinar with people, it'd be something that we could just send out and allow people to watch on their own time. HR people, payroll people, or if you're an employee at a workplace, maybe they sent this out to you. So thanks for hopping on. I own Mana Insurance Group up in Linden, Washington. We've been here since late 2015. I've been in the insurance industry since 2010. In 2017, we were on Nationwide Financial's Dean's List for the long-term care policies that we sold with them across the country. We're affiliated with the American Medical Association, preferred partner with them, and Life Insurance Made Easy, as well as WashingtonLongTermCare.com. Just trying to push all that, get that out of the way so we can jump into some of this for you. But a lot of changes going on, and if you don't educate yourself about them now and make a decision on them, there's not going to be an opportunity to get out of what this new tax is going to be down the road. So you have a bit of a one-time shot to do this and to be able to get out of that. With that, I want to jump into a little bit of what long-term care is and the cost. So there was a study done by Genworth Life Insurance Company back in 2017. It gives you a bit of the idea of the cost for care that is out there right now. Nursing home care, so a Christian healthcare center up in our area here in Linden or in Bellingham, there's Highgate Memory Care Facility that actually someone in my family spent some time at, my grandma did, with dementia. You can see that's going to run right around 10 grand a year. I think that's even increased now. That's for a private room. A semi-private room, you're looking at $8,500 to probably $9,500 now. There's home health care, it's about 5 grand a year. There's adult daycare, that's where you drop somebody off. And so there's all these different types of facilities out there. But I think the biggest thing is as we talk about long-term care, is what is the state requiring that you're going to pay into with this new tax versus what can you get on your own, get exempt from it, and is it going to be better coverage? Is it going to give you more opportunity and more options down the road? So as we kind of jump into this, what's been going on with the Washington Long-Term Care Trust Program? It's been designated as House Bill 1087. It was signed into law back on May 16 of 2019. Since then, there's been a lot of back and forth on what has been kind of a Republican versus Democrat idea on this. And we are the first state in the entire country to look at doing this. There's 5 other states developing similar type of reforms, and 8 other states have an active on-the-ground presence similar to the lobbying efforts that have been going on in Washington for this. So the program basically takes the private insurance market out of long-term care in the state of Washington and puts it into the hands of the government to take care of it. So the reason for this is right now, Washington State currently pays $24,000 per year for a person with in-home care in their state Medicaid program, and $65,000 a year for nursing home residents. That cost is split with the federal government 50-50, and reimbursements from the Trust Act will receive no federal funding once we put this into play. So there's that piece of it too. 7 out of 10 people over the age of 65 will need long-term care. 90% of those people have not saved for it or planned for it or don't have a strategy going into that. So our hope is out of this, even though this is coming about because of a tax that the state is putting in, I guess our hope is that it will allow you and your family to be able to plan for the future, maybe get out of this tax and look at some other options for you. 850,000 Washington citizens are serving right now as family caregivers. By 2040, they think that's going to be cut in half. So there's a lot of care needs that are out there. There's a lot of changes going on in the marketplace with this. And so what I'd like to do is kind of address a little bit how this is going to take place and how it's going to affect you. So supporters of this new program coming out think it'll benefit Washington's overlooked and vulnerable population, maybe people who couldn't afford a private caregiver or a facility, while reducing the burden on the state's Medicaid system. Right now, there's basically a $40 million deficit with the Medicaid program for long-term care. This new bill that they're putting into place, 1087, is going to fund an estimated $1 billion annually to try to overwrite $40 million. So it seems a little bit backwards. The problem with that is as you lose the federal funding from that half that they paid, we can already tell, and the actuaries and the people in the House committees that are running all the numbers and stuff, they already think from the get-go, as this gets issued and going next year, that it's going to be 1 to 2 times underfunded. So the tax that I'm about to show you of what's going to be implicated on any W-2 employees payroll and pay stub is most likely going to double or triple within the next 2 to 5 years is our estimate on that. So the overview is beginning January 1, 2022, all W-2 employees will pay a premium tax through payroll deduction. The initial rate is going to be 58 cents per $100 of W-2 income. To be honest, it doesn't sound like a ton, but when you start looking at how long you might pay into that over the course of time until you retire and the limited benefit that you're going to get out of it, your money is going to be much better invested elsewhere. So all wages are taxable, including stock-based compensation, bonuses, your PTO time, severance pay, all of that is subject to this tax. There's currently a limited period to apply for an exemption to opt out of it. If you have comparable or better personal coverage, we'll touch base on that in a little bit here. The key is to avoid the tax. It takes time, comparison, and planning. So there's not a lot of time to get something done and in place before you're going to be locked into this. Once an employee does opt out, they're no longer to reapply for the program. But at that point, you could potentially come back, and if you dropped your coverage and they found out you dropped your coverage, you'd be subject to the tax, but you wouldn't be able to collect on it anymore. They must elect coverage. Self-employed people are not required to contribute to it, but if they take any W-2 income from that, they are required. So if for some reason you file as an S Corp in your taxes, you have a base salary that you're getting paid, and then you take dividends from your company from the profit on top of that, the W-2 portion you're still going to pay into this on. So the benefits that the state is going to give through this are for approved services. So again, they have to be approved by the state. You have to get approval by them, and they'll be available starting January 2025. $100 a day, lifetime maximum of $36,500 per person that is vested. So it's really not a long-term care benefit. Most long-term care benefits are anywhere from 2 to 6, 7 years that you'll see on the private marketplace. This is going to give you $100 a day for a year. Daily allowance will be adjusted annually by the Washington Consumer Price Index. So that'll be changed, and that'll be an 8-person council that will vote on whether to increase or decrease the benefits, kind of depending on the solvency in the plan. So must be 18 years old or older or 18 or older to collect benefits. The employee must not have been disabled before the age of 18. If so, they cannot qualify for this. Providers are reimbursed directly at the Medicaid comparable rates. That creates some issues as well, because at that point in time, you may have someone who, a provider that doesn't accept that, and they might not want to work for that lower rate that Medicaid is trying to contract at. So that does create some issues there on availability of who you can work with. You must meet the requirement of needing assistance with the activities of daily living, and it's different than the private sector too. So let's look at that. So what the activities of daily living is basically 6 things that you can't do during a regular day. So the reason I got into long-term care originally about 5-6 years ago, and we started doing a lot of it, is I've kind of lived it. And so my story a little bit is I'll go back really quick here on our slides. This is my family right here. So this is my dad, this is my mom, my sister, and these are my kiddos, Case, Taya, and Blake, and my wife, Erin. But in 2001, my dad was diagnosed with Parkinson's disease. Currently, he still has that. Over the last few years, it's really progressed, and we've had dementia set in. And on top of that, my mom's mom had dementia for almost 3 years. So we saw about $10,000 a month going out the back door to a care facility in Bellingham, because my grandpa couldn't take care of her anymore. Now, what's interesting is we get back to these activities of daily living is right now, my grandma would have actually not, she qualified for a policy with the state plan. And the reason for that is she could do all of these things listed here. No issues at all. Maybe a little help here and there with different things, but overall she could do it. The problem was she did not have the cognitive ability. So she didn't understand where she was, who she was with, that sort of thing. So typically on your private long-term care plan, you have these 6 items. You have transferring, so getting from one place to another, toileting, going to the bathroom, bathing, dressing, eating, and then continence, so your bowel movements. If you couldn't do 2 out of the 6 of those, and your doctor wrote you a note saying that you can't, then your long-term care would kick in. The one catch on that is the cognitive impairment. So this portion over here, that was an automatic kicker. So you had these 6, and then kind of as an outlier, you had cognitive impairment. That cognitive impairment would automatically trigger the long-term care. So it didn't matter whether you had two out of the 6 on the other things. If you had a cognitive impairment, the doctor wrote a note saying that, your policy automatically triggers. You're covered for in-home care, for care in a facility, whatever you needed. With the state's new plan, you have these 5. It doesn't include continence. You have the ambulation and mobility. You have medication management, personal hygiene, body care, and the cognitive impairment include. You need to have 3 out of the 10 of these, but the cognitive impairment is not an automatic kicker. And to me, that's a little alarming with the amount of dementia care and Alzheimer's patients that we have, is that cognitive impairment's a big piece, because you can have people who can do a lot of this stuff that now they are not going to qualify for what the state is going to offer compared to what is offered on the private market. So I share that with you because I think that's a really big deal. And that's a point that I think the state's really missing on this. And whether we like that the state's doing this or not, it doesn't change the fact that the accessibility to what they're offering, there's some struggles to get there with it. It's not going to be necessarily easy to be able to collect on it as well. So if those 2 out of the 3 out of the 10 daily living activities by the state are satisfied, then benefits can be used for home care, home modifications, adaptive equipment, home delivery meals, training and compensation of qualified family caregivers, and if needed, assisted living, adult daycare, and nursing home services. Benefits are not available for employees who have already retired, not residing in Washington State when qualified to receive the benefit. So let's say you work really hard, you retire at age 65, 67, whatever it might be, and you decide you want to move to Arizona. You want to be a snowbird, let's say. Or you move down south to Florida. Those are the 2 best retirement states, they say. So you head out of town and you're down there, and this long-term care kicks in. You may have paid into it all these years. You will not qualify to take any of it because you don't currently reside in the state of Washington. And that's a big deal because you're going to pay into something for all these years. If you're like me, I'll be 38 at the end of this month. So I'm going to have 20, 25 years left until retirement. And all of a sudden, I'm not getting what I paid into it for. So those are things to consider with this as well. The employee is not vested in the program, so they're not available. You have to work at least 500 hours a year to be considered vested into this program. The employee must have contributed for 10 years without an interruption of 5 or more. And the employee must have contributed for at least 3 years in the last 6 years. So there's a lot of restrictions with it and a lot of red tape. Here's kind of how the timeline works. So if you're 10 years or more from retirement right now, you're going to start paying into it January 1, 2022. There's going to be no coverage for those first 3 years. And then at that point in time, there's going to be, at 2025, you're covered moving forward at that point. The kicker is if you're less than 10 years from retirement, you're going to pay into it starting over the next 3 years. 2025, you would be covered, but you would only have 7 years worth of coverage, 2025 to 2032. that there would be coverage on that. So those are things to kind of consider. So even if you're close to retirement, you're like, hey, you know what, I'm not going to pay that much into it. I'd rather just not mess with it. You're going to pay into it, and you might only get a limited amount of coverage. Why wouldn't you find something that's actually going to work for you and work a little better if you actually need it? So opting out. So employees may apply for an exemption with an alternative long-term care coverage. The only opt-out time frame, though, is between October 1, 2021, this year, but you have to have a policy in force by November 1st. So originally it was going to be in July. That has actually changed, and our slide is actually kind of old on that. It actually just changed recently, so it's November 1 the policy has to be enforced by. So you can submit that policy to the Employment Security Department between October 1 and December 31, 2021. Now, if you go down to the next bullet point on the slide, it talks about the Employment Security Department will accept applications for the exemption only from October 1, 2021 through December 31, 2022. If you currently reside in the state of Washington, you need to make sure that policy is issued and done and in your hands, all wrapped up from your agent before November 1st. If it is after that, it will not qualify. Now, the reason they say December 31, 2022 for submitting those policies that are issued before November 1 is if you have someone, let's say they move in from the state of Idaho into Washington, and they already had a policy prior to November 1st in place from another state, they can submit that all the way up until December 31, 2022. But if you live in the state of Washington, you need to have that policy submitted before or by October 1, 2021 through the end of 2021. Only employees age 18 or older can apply for the exemption, and it is the responsibility of the exempted employee to provide written notification to current and future employers of the approved exception. Qualified long-term care policies in the state of Washington are a long-term care insurance contract, long-term care riders on a life insurance or an annuity contract, long-term care riders purchased under group coverage, and then not qualify are policies with lump sum payouts. So a lot of times there's these chronic illness riders or critical illness riders on life insurance platforms. If they pay out a lump sum all at once, it doesn't work. They want to make sure there's a monthly payout for long-term care if that need arises to satisfy the state, as well as not only the monthly payout, but the max payout has to be greater than the $36,500 that the state is offering. So that is a very fast run through of what is coming up. And, you know, to be honest, whether you like it or not, this thing is coming. There's a lot of, to be honest, better options out there for people. And like I had hit on a little earlier, is we recognize that this tax is going to increase. There's no cap, or there's no wage limit on it. There's no cap on the tax that they've set. They can increase the tax every 2 years. It's already planned to increase in 2024. So one of the resources that we've used and we've partnered with is WashingtonLongTermCare.com. We're one of their affiliated brokers. And on that website, WashingtonLongTermCare.com, it's listed here on the screen right now, is there's a tax calculator. So you can go in there and you can put your current income earnings, what you make a year. You can put your current age and what age you plan on retiring, and it will give you the number of the estimated tax that you'll pay into it. Keep in mind though, as you do that, that is a complete baseline. That's the minimum that you're gonna pay. But as they're talking about it already, this whole thing is gonna be completely underfunded from the get-go. And the tax is going to increase. And my guess is it doubles in 2024, and we see another rise in 2026 on it. So take advantage of the opportunity to opt out of it now. My kids, I have kids that are 12, 9, and 6. They're going to have to pay this if they decide to live in the state of Washington. There's no way around it for them. But if you know of anyone out there that is making a decent wage, maybe they're in college right now and they're going to graduate, and the field that they're going to go into, you know that they're going to make a good earning sometime. They need to get something on them right now. We have options for them. So those are the things to consider. It can be, you know, the older you get, the more expensive things kind of get. If you can lock in when you're younger too, that's better. but that doesn't mean that just because you're older, there's not a good option for you. So Blake Whitman is on this call with me as well. And Blake is kind of my right-hand man with this. He's helping me process everything. And I asked him to just jump on. And Blake, why don't you just kind of give a quick 2 cents here, and we'll try to wrap this up then when you're done.
Yeah, absolutely, Dan. I'm helping out Dan process the majority of these policies. One of the questions that comes up right away is, okay, what does that process look like? What can I expect? In order to get you a quote up front, all we need is your date of birth to begin with. From that point, I can put together some illustrations for you. We can go through, talk about your different options, get your levels corrected. And once we go through an application, which usually is probably a 10 to 15-minute phone conversation where we go through the application together. Then I send that in to the carrier. At that point, then I just kind of play middleman back and forth. But probably one of the things that I really do suggest, I know that deadline is November 1st. However, depending on your health and kind of the backup and the underwriting, it can take anywhere from a month to get through and be enforced to 4 or 5 months, sometimes up to 6. So a lot of people are kind of thinking, oh, I have till November. I'm going to wait until August, September, October. I would highly advise against that, just because we're seeing so many people asking for these policies at this point, trying to get out of the state-run one, that there's just a backlog. So I highly suggest that this is something you get on now and kind of get ahead of the game a little bit. But from that point, that's really what to expect in the processing department.
And it's not just a backlog on our end at our agency with MANA. It's a backlog in the industry as a whole. So underwriters from different carriers, the medical bureau who releases all the doctor's records, medical records, paramed exams, if those are needed, all of those are backlogged right now. And we're just seeing massive amounts of applications coming in. And so I'd highly encourage you guys, whether it's through us, we would love to work with you. Our biggest thing is service and taking care of people. Or it's through your own broker. Just make sure you got options out there and you're educated on it. And we highly encourage you to look at what you can offer. My email there is on the screen, and feel free to shoot me a message, give me a call, shoot me a text, however it works. But this isn't something that we just sell. I own these policies on myself, my wife, my mom, my in-laws. I know Blake's folks got it. It's stuff that our own families have, and that we're recommending, and that we're encouraging people to really take a look at. Because if you don't plan, the state's going to plan for you, and that a few things happen. You're not going to get the care that you really deserve or desire when that comes, and you're also going to really pay for it and not get a great return on what you're paying into. So those are my last kind of 2 things. Blake, anything else?
No, I think you covered it pretty well. I agree. Just this is something that we're very passionate about and highly advised. So if you want any more information, get a hold of Dan. Like I said, I'm just working alongside of him, kind of in the background. We would love to get to work for you guys and help you out however we can.
Awesome. Thanks, everybody. We appreciate you guys jumping on, and we'll be in touch soon. If you need anything, please let us know.